Hey guys, so long time since I recorded, but in this video I want to go through my newest stock buy in the public account, and I want to talk a little bit about the market right now. Everything has been dropping for the past few weeks while this Iran war has been going on, and oil markets are going crazy. Oil is over $100 a barrel for both WTI and Brent. So it's wreaking havoc on all these stocks. Today is a little bit of reprieve. It's going up a little bit, but yeah, there's a lot of chaos in the market right now. So I want to talk about that and talk about this new stock that I bought today, and that stock is AMR, Alpha Metallurgical Resources. So this is in the same vein as Warrior Met Coal, and they do met coal production, mining, and they mine it for steel production to sell to other countries and domestically, but we'll get into that. So if you like this content, please like and subscribe, and let's get into it. So like I said, Alpha is another met coal play. It's also in the Monish Prabrai fund, and he has that alongside with HCC and a couple of energy plays in terms of Valaris and Noble, which are more offshore oil drilling components and plays. But for Alpha and Warrior Met Coal, these two are the prime met coal producers in the US. And Alpha has their mines located in Tennessee and across Virginia and West Virginia. They are an Appalachian type miner. You can see on this map here that they're in Tennessee, West Virginia, Virginia. And that's where all their mines are. They have many more mines than HCC. HCC has basically 3 mines. AMR has several mines in all these locations. You can see that in Virginia they have about 4 locations, operations going. West Virginia they have so many more. And the Kingston Wildcat mine is one that they're building out and are going to finish soon. So that's going to add to their production of met coal annually. So let's go through their investor presentation. They recently reported the fourth quarter 2025 results along with their whole fiscal year 2025 results. So let's go through this investor presentation to see their numbers and their financials. So here they are the #1 producer of met coal domestically. So they are beating, in terms of production, Warrior Met Coal. They mined 15.3 million tons of coal in 2025. Their adjusted EBITDA for 2025 was $122 million. And of that, their sales mix by shipment is 25% domestic and 75% export. So international, they do mostly international sales. That tracks. Met sales by type, they have 14% low vol, 21% mid vol, 31% high vol B, and 34% high vol A by sales and type of coal. They have 3,960 employees, and that's the basic gist of it. They have operating 19 they're operating 19 mines in those states that I mentioned, 8 preparation plants, 2 standalone loadouts, 1 dock, and 1 export terminal. So that is a kind of a choke point where they have 1 export terminal and 1 dock, but it hasn't really hindered them in terms of getting this coal out to their customers. Now they're focused on safe production and environmental stewardship. Their overview of their mining complexes. So a mining complex is just an aggregation of several mines put together. So in West Virginia, their mining complex Moorfolk has Black Eagle, Panther Eagle, Horse Creek Eagle, Glen Alum, and these other 2. Their primary products, and it has a breakdown of all their primary products that they produce out of there or mine out of there, and the method to which they get to their transportation to their customers. So CX CSX. These are all rail, by the way. and the method to which they get this to the dock or to the export terminal. So all of these are rail for all of these. And then they have several other mining complexes in various locations, and you can see that there are about 7 here. Historical tons produced, they were producing roughly around the same amount, a little bit less in 2024 and 2025 based on the past 5 years. And that can be a decision based on how much they want to push into the market, what are the market conditions for met coal and steel production globally. So all of these factors influence how much they produce, how much they want to sell from their reserves. So production by complex, you can see in 2025 that most of it was from Norfolk, and that makes sense because they have the most mines. Then McClure, Toms Creek, then you have Aracoma, Kingston Mammoth, Kepler, and then Power Mountain. And also reserves by complex based at the end of 2025, you can see Norfolk has the most. So their investment thesis in Alpha is basically an industry leader in that market. So you can see that they account for 1/5 of 20% of the total US met coal production, essential to steelmaking process that enables global infrastructure growth. A diverse portfolio of coal qualities to serve different customers around the world. Majority ownership of DTA export facility in Newport News, Virginia allows for global reach. They owning the export terminal to get this coal to their customers is real benefit because it lowers their cost of sales, it lowers their cost of transportation, all these things. So that's really important. And one of the major reasons that this is a good investment. They have financial strength. Another major reason to own this and put it in your portfolio is their leadership's focus on capital returns, capital allocations through buybacks specifically, not just dividends. So they've put aside dividend returns and focus solely on buybacks as the capital return mechanism. And that's super, super critical because that is probably the best way to return capital to shareholders, as long as they are doing those buybacks when the value is there for the company. So there's an intrinsic value, a discrepancy between the intrinsic value and the actual price that the shares are trading at, then it's important to do buybacks. But if the price is super high relative to their intrinsic value, then it's not a good time to buy back shares. So as long as they're buying back shares when the intrinsic value is very high and the price is very low, this is great investment for long-term value investors. They're focused on capital projects that support operational excellence, growth, and long-term value. They have a seasoned management team. Their shareholder value, like I was telling you, is returning capital to investors through share repurchases calibrated to the company's free cash flow generation. So that's important too, because free cash flow is how you determine intrinsic value in a DCF model. So if they're doing it attuned to how much free cash flow they're generating, if they're generating high free cash flow, technically, and into the future, their DCF value should be pretty high. Their intrinsic value should be pretty high. So if they're doing that based on their share free cash flow, their share repurchases, that's pretty important. And they've demonstrated focus on consistently creating long-term shareholder value through disciplined capital allocation. So they've retired so many shares. I believe it's around 33% of their shares in the last 4 or 5 years. So that's a very, very strong, disciplined focus on share repurchases. Now, just like Warrior, they are anticipating a robust growth in steel demand, as well as a met coal supply decline after 2029. So after 2029, they're going to see, places like India experiencing higher steel demand, which requires more met coal because of how met coal is used in steel production. But they're also anticipating a decline in the global met coal supply. So both of those lead to increased demand for met coal and reduced supply of met coal, which is higher prices for met coal. So that's another investment thesis for long-term these met coal companies. So that's another thesis for holding and buying for the long term these met coal companies. And like I said, they're anticipating Indian steel demand to continue well into 2020. And like I said, they anticipate Indian steel demand to grow based on, just infrastructure projects and development in the country through 2050. So 4.4% CAGR, just a steady CAGR rate, low CAGR, but this continual uptick in that steel demand. So that will provide a backdrop for met coal demand and the price, a floor for the price. Now they are the largest, so they produce all types of different steelmaking coal types. They have 14.1 million in met coal sales in 2025. They produced more than that, but that's how much they sold. And I anticipate this to increase when their Kingston Wildcat mine is complete. Now, this is probably the most important thing for long-term value investors in AMR. And you can see their ramp up of share buybacks in their share repurchase program. $150 million in 2022, $600 million in 2022. So $150 million in March 7th, 2022, $600 million in May 7th. So you can see the increase in their share repurchases. In 2022, they just ramped up 150, 600, 1 billion. And then in 2023, they went to 1.2 billion when, COVID was driving the met coal price way higher. And then 1.5 billion in 2023. So they did huge amounts of buybacks in these 2 years. As of February 20th, 2026, the company had repurchased 6.9 million shares pursuant to the share repurchase program for a total of $1.1 billion. So you can see it here. They had about 18.58 million shares at the beginning of March 9th, 2022. They had some warrants and equity rewards that added to that share count, but then they bought 6.925 million shares back, and now they're sitting at around 12.792 million shares outstanding. So that's a huge drop in such a short time. 4 years they dropped it that much. So if they continue to be focused on that, and that's what management has indicated and demonstrated, that this may drop even further. So here's their financials. Here are their capital allocation priorities. Strong balance sheet with conservative leverage ratio, so you can continue to operate without going bankrupt. Flexible operations enable strong cash flow generation potential across the cycle. And target minimum liquidity of 250 to 300 million. So anything on top of that probably be put into CapEx and then share buybacks. Annual CapEx predominantly allocated to maintenance with smaller amounts to growth investments. Prioritizes capital expenditures for health and safety, followed by operational maintenance and growth CapEx. And management continues to evaluate capital allocation through multiple factors such as capital needs, investment, and growth opportunities. track record of returning capital to shareholders through share repurchases. Now, their revenues have been tracking down because they are a higher cost producer than Warrior Met Coal, for example. So they make less when they keep less when the prices depress from their production, because they have to spend more to make that, to produce that coal and also to sell that coal. But overall, they're still making money. But overall, they are still doing well. They're, since the COVID highs, they're really come down a lot, and their free cash flow has gone negative now by 20 million in 2025. But once this picks up in any meaningful way, the met coal industry, this will shoot back up because they have way more torque to the upside because of their share repurchases, because of how they are producing, the number one producer. So they have scale, they have share repurchases, which can amplify any returns based on met coal going up in price. And one of the more important things that I want to stress is that one of the more important things I want to stress for AMR investors is that once they cannot buy back any more shares just because, institutions hold shares, hedge funds hold shares, the insiders hold shares, and once they've reached to a point where in the future where they cannot literally buy back any more shares because no one else is selling these shares to them, one, that will increase their price, their stock price, many-fold, which is a huge investment thesis for me owning these shares. And also, if the management is still there and still allocating capital back to shareholders, there's only one other way to do it, really, and that is dividends. So not only do I anticipate a huge increase in the share price due to all these buybacks and reducing the shares outstanding, I anticipate a switch at some future point from share repurchases to dividend allocations. And those dividends could be massive. So if you build up a stock position now, 100 shares, 200 shares, 500 shares, 1,000 shares, the dividends that could be paid in future years, 10 years down the line, 15, 20 years down the line, could be a massive amount of money based on how many shares you have. So we're talking about if they get their share count to 4 million shares outstanding, and Monish talked about this in a recent interview about AMR and HCC and of various other investments. If we get to, and this is totally hypothetical, we get to a point where AMR has 4 million shares outstanding and they can't buy back anymore at reasonably without some major investors selling their shares. One, their share price will be very high. And two, if they have $1 billion in free cash or more, and they want to return $1 billion in free cash back to shareholders, that would mean a $250 dividend per share, because $250 per share times 4 million shares is 1 billion in equity, or in return, capital return. So you have 100 shares or 500 shares or 1,000 shares, you can see how that dividend could be immense, and that could be for many years into the future, depending on their free cash flow generation. If they generate $1 billion or like 500 million, you could do the math to see how much they would be returning back to shareholders. But the point is, it will be a very large amount based on the number of shares you have. So that's also a great thing to see, not only the price appreciation in the stock, but the dividends could be massive into the future. Now you can see their capital expenditures. They did about 11.5 million carryover development projects, very small 9.5 million. And you can compare this to the capex, the development capex for Warrior Met Coal, where they're doing Blue Creek, and it was 70, 80 million per time frame where they reported it, and it altogether was over $1 billion, which they've been working on for several years. So here, their development projects are a very small piece of their capex. And then maintenance capex is more than Warrior Met Coal, because Warrior Met Coal only has 3 mines, and here they have 19 mines. So it's 137 million. But if they are able to capture a large increase or increase in met coal prices, with their production and scale, they're going to have way more than that maintenance capex in, revenues coming in through the door. Now, Alpha has shown the ability to adjust its capex based on market spend and market dynamics, currently developing Kingston Wildcat, new underground mine in West Virginia. The mine is expected to produce a low volatile product, finishing development build-out prior to production, estimating 500,000 tons in 2026, ramping up to a full run rate of 900,000 tons expected in 2027. So yeah, that's a meaningful increase in their production. Even if they're making 14 or 15 million tons right now, add another 500,000 tons to it, that's pretty good. It's not a super game changing, but any increase will keep their status as the highest producer intact and increase their bottom lines, top line and bottom line numbers. Okay, so let's move on to the actual full year and fourth quarter update on their investor letter. So they reported a loss of $17.3 million for the fourth quarter 2025, post adjusted EBITDA of $28.5 million for the quarter. And here are the numbers. 17.3 net loss per diluted share was $1.34. Adjusted EBITDA was $28.5 million. Adjusted EBITDA was $28.5 million. Operating cash adjusted EBITDA was $28.5 million. Operating cash flow was $19 million. Capital expenditures $29 million. And tons of coal sold was 3.8 million as of December 31st, 2025. And you can see the comparison to the 3 months ended before that. This is 3 months before that, and this is the year before that. So all in all, as an overview, I'm just getting into this position. I'm DCing into AMR and trying to get a bunch of shares, because I think in the future, as you saw by the demand charts for steel demand and met coal supply, I think the future years there will be a meaningful change in the met coal industry and the price of met coal in all different qualities, especially the premium low vol qualities. And that will increase the revenue and earnings and free cash flow of AMR to the point where they can do more huge buybacks of their shares, which will increase their price and get them closer to that switch over from share buybacks to dividends. And that's my play and overall investment thesis here in AMR. Now, looking at Simply Wall Street here at their valuation section for AMR, you can see that they are 30.2% undervalued. They're saying there's a cash flow value. They're saying there's a cash flow value of $319.69 per share. Currently, it's around $223 per share. So that is a 30.2% discount. Honestly, I think this can change over time, and I believe the value is much higher just because this only captures the shares outstanding right now, but we know for a fact that AMR is laser focused on share buybacks, so the actual share count number that's being used in this calculation will keep going down in future years. So this is just a rough estimate, but I believe it's much higher than this based on the shares floating, based on the shares floating going down, and them having more revenues, earnings, and free cash flow based on a higher tick in the met coal prices into the future years. So I believe this is going to be much higher. Now, a brief summary of all of this stuff that's happening with the war in Iran. It's really shooting up the oil prices. You can see that, oil prices, gas prices have gone up for the last 4 or 5 weeks. This is really putting stress and pressure on the Fed, and expectations of Fed rate cuts have all but disappeared. And they might even be, and I posted this on my socials, they might even be looking at a increase, a hike, to combat the effects of the higher oil prices. So this has really turned the futures markets volatile. Gold, oil, the indices, all of those things have become very volatile based on this war. And there's going to be lasting impacts on oil prices for sure into future years, but also equities, other commodities, things like that. The bond rates going forward. So very few people know that this war will be impacting if you want to buy a house, because the 10-year interest rate is very tightly correlated with the mortgage rates that are charged. So if the 10-year rate is high or is increasing, that means mortgage rates are also probably increasing. So if you wanted to buy a house, this war is actually directly affecting you. This war is indirectly affecting you because you may have to be paying more if you are truly trying to get a house, or you might be priced out altogether. So those are some of the effects, the subtle or indirect effects of this war on U.S. economy and global economy together. And I'm not following their day-to-day war updates all the time, but as far as I can tell, this is not ending anytime soon. It looks like they're doing more attacks while they're doing talks as well, through an intermediary, through a mediator, through Pakistan. So this is not looking that good, and I know that there's going to be volatility and uncertainty. And one thing investors hate is, or traders and investors hate, is uncertainty in the market, because that doesn't let them pick a direction. It's very hard to find trends in a volatile market that's ranging or trying to figure out what's happening. And it can change on a dime with one new statement. So those are my thoughts on this war right now. I'll put more thoughts in a future video on these things, maybe talk about the commodities and other things, but that's what I think right now. So if you like this content, please like and subscribe. I'll get to more content later this week. So if you like this content, please like and subscribe, and I'll see you guys in the next one.